Investing in a company without understanding its fundamentals is like driving blindfolded. You might get lucky, but the risks are enormous. Most beginners focus only on stock price or hype, ignoring the metrics that actually determine long-term success. The truth is, companies that look flashy today can fail tomorrow if their financials and operations aren't solid. In this video, you'll learn how to evaluate a company before you invest, using 5 key metrics that professional investors rely on. By understanding these indicators, you can make smarter decisions, minimize risk, and maximize your potential returns. Evaluating a company isn't complicated. It's about asking the right questions and knowing where to look. From profitability to growth potential, each metric reveals a different side of the business. Investors who focus on fundamentals consistently outperform those who follow trends or news headlines. By the end of this video, you'll know exactly what to check before putting your money into any stock. This knowledge helps you avoid hype traps, spot hidden opportunities, and build long-term wealth. Let's dive in and see how you can separate strong companies from weak ones before investing. 1. Revenue and revenue growth. Revenue is the total money a company earns from its products or services. It's the most basic measure of business size and market demand. But looking at revenue alone isn't enough. You also need to evaluate growth trends over time. Consistent revenue growth indicates that a company is expanding its market share, attracting customers, and increasing sales effectively. Investors should compare growth rates to competitors and industry averages to see if the company is outperforming or falling behind. Revenue growth is a leading indicator of potential profits, but beware of companies that grow too fast without sustainable margins. Look for stable, repeatable growth backed by strong business models, not short-term hype. Seasonal fluctuations or one-off deals should be analyzed carefully to understand the underlying trend. Tracking revenue over multiple years reveals the company's real trajectory and resilience in different market conditions. Strong, consistent revenue growth suggests that the business is solving real problems and capturing demand efficiently. 2. Profitability metrics. Net income and profit margin. Profitability shows whether a company is actually making money after covering all expenses. Net income tells you the absolute profit, while profit margins indicate efficiency. How much profit is generated per dollar of revenue? High and consistent profit margins usually reflect strong pricing power, operational efficiency, or a competitive advantage. Investors should compare margins over time and against industry peers to spot strengths or weaknesses. A growing company without profitability may burn cash quickly and struggle to survive long-term. Look for trends where net income is increasing in line with revenue growth, signaling sustainable expansion. Companies with improving margins often have scalable business models that can generate more profit without proportionally higher costs. Profitability metrics are a reality check. Revenue is great, but profits are what fund dividends, reinvestment, and growth. Even small improvements in margins over time can compound into significant wealth. Understanding profitability also helps investors predict how well a company can weather downturns or invest in future. 3. Debt levels and financial health. Debt can help companies grow, but too much debt increases financial risk, especially during economic downturns. Key metrics include the debt-to-equity ratio, interest coverage, and total liabilities relative to assets. Low or manageable debt indicates financial stability, while high debt may signal risk if earnings can't cover interest payments. Comparing debt levels to industry standards is essential. Some industries naturally operate with higher leverage than others. Healthy companies maintain a balance between debt and growth opportunities, using borrowed capital strategically rather than overextending themselves. High interest expenses can eat into profits and limit flexibility for expansion or innovation. A financially strong company should generate enough cash flow to cover debt comfortably while reinvesting in its business. Checking the balance sheet reveals whether management is prudent or reckless. Investors want companies that can survive challenges without risking bankruptcy, ensuring consistent long-term growth. Monitoring financial health also allows you to spot potential warning signs before a company runs into serious trouble. Fossewa cash flow, operating and free cash flow. Cash flow shows the actual money coming in and out of the business, often more revealing than accounting profits. Operating cash flow indicates how well the company generates cash from its core operations. Free cash flow, the money left after capital expenditures, shows the funds available for dividends, debt repayment, and expansion. Positive, growing cash flow is a sign that a company can sustain operations and invest in future growth. Even profitable companies can fail if they run out of cash, so cash flow analysis is critical. Negative cash flow over extended periods can indicate underlying problems, even if net income looks good on paper. Investors should track consistency, seasonality, and efficiency in turning revenue into cash. Strong cash flow allows companies to invest in new projects, pay down debt, and return money to shareholders through dividends or buybacks. Companies with robust cash flow are better positioned to weather downturns, seize opportunities, and fund long-term growth without relying excessively on external financing. 5. Valuation metrics: PE ratio, PB ratio, and price to sales. Valuation metrics help investors determine whether a stock is reasonably priced compared to its earnings, assets, or sales. The price to earnings (PE) ratio shows how much investors are willing to pay for $1 of earnings. Price to book (PB) ratio compares market value to accounting value, revealing whether a stock is over or undervalued relative to its assets. Price to sales (PIS) is useful for high-growth companies that may not yet be profitable. Valuation is relative. Compare metrics to industry peers, historical averages, and growth prospects to assess fairness. A high PE might be justified for rapidly growing companies, while a low PB could indicate undervalued opportunities or potential weaknesses. Understanding valuation prevents overpaying for a stock and increases your chances of long-term success. Metrics are guides, not guarantees, but they provide a reality check against hype. Smart investors combine valuation with fundamentals to make informed decisions and reduce the risk of buying overvalued stocks. Proper valuation ensures you're investing for growth, not speculation. If this video helped you understand how to evaluate a company before investing, start applying these 5 key metrics to your research today. Review revenue, profitability, debt, cash flow, and valuation for every stock you consider. Share this video with someone who wants to invest smarter, hit the like button, and subscribe for more actionable investing insights. Remember, knowledge is your most powerful investment tool, and evaluating companies properly can dramatically increase your chances of long-term wealth creation. Start analyzing smarter, track these metrics consistently, and watch your investing confidence grow with every decision. Understanding these fundamentals allows you to avoid hype, spot opportunities early, and make wealth-building investments with confidence.